No, I know it's because I haven't switched my microphone on, but I have now. Hello, everyone. Good to be here. Just move the chat box out of the way. Hopefully you can hear me all okay. Excellent. Right. Let's just move that down. Right. I thought we'd start with oil because, like Anna, this is just, if I was doing an examples book of VPA in action, this is probably an example I'd take because it's just a no-brainer. This is VPA 101, if you like. And really, this chart's a 5-minute of oil. We had I'll just close that down, show you where we are. This is the daily. You might not be able to see it, but oil plunged to just over $38 a barrel, 38.10, I think, and it's come all the way back up to $40.20 at the moment. September contract. And what I want to show you is this because it's just classic VPA in action. And it's one of those signals that, to be honest, it would be hard to miss if you saw this. And these are the sorts of trades which are real no-brainers. And all you're waiting for is a decision of where you're going to get in personally, how long you're going to stay in the trade, but the actual signal of buying is impossible to miss. Just widen this out a bit. There we go. Make that a little bit easier. So what do we get? This is open of the cash markets. We get the classic price waterfall. We had some volatility in here. We had it crashing through the volume point of control. On down we go. Then we start to see the first signs of potential buying. Very high volume, wick to the lower body, narrow spread candle. Then we get this massive hammer candle at the bottom. Now, in addition to that, it's really doubly confirmed, if you will, because we get a volatility trigger with it as well. You may not be able to see that, but I can assure you it's there on the candle, and that would have come in real time, but the volume is just absolutely monster. That is only telling you one thing. That's buying on a grand scale by every man and dog in the market. They're all buying like crazy. The big operators are buying into this move. Off we go, up to the upside, support. Then what do we see? We see a minor pullback. Why is it a minor pullback? Because it's under falling volume. So we've got a 2-candle reversal here. Is this a reversal back into the primary trend of bearish? Answer, no. Why? Because you've got falling price and falling volume. The next candle is then a giveaway. You've got more buying coming in. On up we go. And the other point about this little configuration of candles here, which is slightly more nuanced, is this, that if you look over on the volume here, this has been crashing on high volume. And yet when you look at this candle here and the volume associated with it, it's very low in comparison to this. So what does that actually tell you? What it tells you loud and clear is that the selling pressure that was over here, in other words, in the same region of price, has now been mopped up in the market. You can use any analogy you like. The one I tend to use is of mopping up a spill, a sponge if you like, and that is what is stopping volume. It's explained in the book. We talk about it here. It is basically stopping volume. In other words, the volume is coming in. It's bringing this market to a crashing halt. It doesn't happen generally in terms of a V-shaped rally. You see them occasionally. You'll see it do that, and it'll go straight up in the air. But generally speaking, what you see is this sort of behavior where you get the effort to rally, you'll get the selling pressure has been mopped up. It's telling you that by virtue of the volume. And then you get further buying coming in, and then off we go up to back to the volume point of control. At which point, depending on where you got in, you may say, fine, okay, I know what's going to happen next. We're going to get consolidation. Why are we going to get consolidation? Because we're at the volume point of control. We've also got a very nice channel defined here of, if you like, downside support and upside resistance. We managed to get through it here, but then the close came back below it again. Volume wasn't great. Then we come along and test it again. We've got a platform in below. We're trading around it. And then we get the injection of volume down here to actually move us away from the volume point of control. Nice little move through this low volume region here on the node. So we're expecting the market to move through there fairly rapidly. We've got volume building in this region, but if we get above 40.30 per barrel and up towards 40.40, then the amount of effort to break through there is going to require less in terms of the volume, the fuel, if you like, driving down here in order to move it through this region than it would to move it through one of these high volume regions, because there is very little in the way of either volume to cause a resistance to the price action, And in addition to that, you've also got very little in the way of price-based resistance. This has only been tested once. This has only been tested twice. That's the accumulation distribution indicator, which basically works on price. So it's constantly looking. This one here was tested 5 times. This one here was tested 4 times. And that's the reason the line is thicker on these levels, because what the indicator does is widens those lines according to the number of times a region is tested. So you get this fantastic visual representation, not only of where these levels are, but their relative strength. So these little ones down here of 1 are very minor. These ones up here are serious. So where we've got 4, 5, 6, and so on, particularly where they combine with the volume point of control, or whether you get a cluster of them, they are going to be very strong indeed. So what we're waiting for now is a continuation of that trend higher. And obviously what we've also seen there is the transition of the trend monitor. It's transitioned out of bearish into the transitional colors. It's gone into bullish. It hasn't changed through this phase of price action here. It's basically saying it's telling us the trend is still maintaining bearish momentum, and therefore there is no reason to exit. And when you use it in multiple time frames in that way, it is immensely powerful. You can see it here on the 10-minute. This was what we saw, the equivalent price action. Very similar. We had volatility triggers 1, 2, 3. That was the last one. Then we had this one with ultra high volume. There must be buying in there. There has to be. And really, this just gives you a different view of the 5-minute. In other words, 2 times 5. It gives you a 2 times slower time frame to look at the price action and give you different perspectives on what is going on. And when you also look at it, of course, you get a very different view in terms of both the volume histogram on the 10-minute. We're still looking to push through quite heavy volume here. This is, there's a concentration of volume. Where we are at the moment on this bar, there's a lot of volume sitting in that relatively narrow price range. And that's why the price is finding it quite difficult to push through there. And you can also see, look at the volume here. We had good volume on the first one, then we've had a little bit of weakness coming. We've got a wick to the upper body, so it's struggling at this level. It's tried to go through up to the next level, but again, it's got a wick to the upper body, so it's struggling. It hasn't got a wick to the lower body, it's got a wick to the upper body. So it's really struggling at this region. And remember also that a slower time frame in any context will trump a faster time frame, and by that I mean anything you see on a slower time frame, whether it's a volume relationship, whether it's resistance, whether it's volume resistance, whatever it is, that means that it will carry more weight because it has the weight of time behind it. So, and if you think about it, common sense logic would tell you that something that happens on a 30-second chart or a 1-minute chart is very quick, but you would expect something that happens in the same way on a 10-minute chart or a 15-minute chart or an hourly chart. For example, if you were looking at a congestion phase or resistance area building, that region is going to carry substantially more weight the slower the time frame. So if you see things on a daily chart, they are going to carry massively more weight than something you see on a 5-minute chart. They have to, because by virtue of the fact this has been going on a long time on a daily chart, it means it carries enormous weight, enormously significant in terms of the price action. So that's what we're seeing on 10 at the moment. But I wanted to show you that because it's just a classic example. And that was a 5-minute chart. It could be, on a 15-second chart. Everything you see, whatever time frame you're looking at, it's replicated. We've got a volatility trigger here. There we go. We've gone from 40.17. We've got to, 6 cents a barrel here, shot up. We've got the volatility trigger. What are we expecting? Either congestion or reversal. Well, we're getting a reversal, albeit this is a 15-second chart. Now we've got a big spike of volume coming onto that candle. In fact, that's like it's a hammer candle. There we are. You probably can't see the wick, but it goes down to there. So the market's fallen, it's shot back up, and we've got decent buying under that particular candle. See what the next candle does. Okay, we're trying to push higher, chopping about a bit. It doesn't look like it's going to rally very strongly at the moment. The trend monitor is bright red. So it's just telling at the moment we've transitioned out, we're in a bearish phase of price action, but remember this is 15 seconds, so this is very fast. A little bit more buying coming in under there. You can see the volume here. So there's definitely buying around this region at the moment. Let's just pop that back up there. Now let's hop over onto the, I'm just going to switch off for a moment, if I may. I'm just going to change charts.